Hi, Reality and XT viewers. I'm your host, Kritika Singh Rawat, and welcome to a new episode of Let's Talk Business. In today's exciting conversation, we have a distinguished entrepreneur who has made significant strides in the realm of fractional ownership and has recently taken the helm at Aurum WiseX. Please join me in welcoming Aryaman Vir, the CEO of Aurum WiseX. Aryaman's journey from engineering to diving deep into the world of finance and real estate investment is truly inspiring. His brainchild, Myre Capital, has left a remarkable mark in the industry, and we are here to explore his vision, his recent acquisition by Aurum Proptech, and his thoughts on various aspects of the real estate landscape. From the inception of his entrepreneurial journey to the strategic moves that led to the acquisition, we are diving into it all. We'll also get his insights on the ever debated topic of REIT versus fractional ownership, his vision for the future of Aurum WiseX, and so much more. Thank you, Aryaman, for joining us today on Let's Talk Business by Reality and XT.
No, great to be here. Looking forward to the conversation, and thanks for inviting me on the platform.
So first of all, congratulations on the PropTech, Aurum PropTech acquisition of Myre Capital. So before we get into that, I want to know where the journey started. How did you first of all create Myre Capital, and what motivated you to venture into real estate investment?
No, absolutely. It seems like it was a long time ago, but it wasn't. 3 years ago at the start of the pandemic, I was actually in the US, so I did my education from there. I was working there. And at that point in time, I was exploring various investment models. I was working on Wall Street. So I came across this whole aspect of enabling people to invest in real estate, which wasn't the traditional HNIs or the institutional investors. They've opened up the market to a larger segment. And that's really where I started to draw inspiration. I started to find equivalent models in India. And initially, when I was doing so, it wasn't really to start a platform like that. It was to invest myself. And when I found a lack of options, that's when I realized that there's some level of opportunity. One thing led to the other. I took the Vande Bharat flight back to India.
Nice.
And we conceptualized and launched the company actually in lockdown 1. So interesting times, but that's really how it began.
And I'm sure our viewers would be also interested to know, you are an engineer, right?
Yes.
Your background is an engineer. How the change, of course, you notice the market, but being an engineer, I'm sure it must have been a different path when you went into that particular college and chose that particular field. What made you shift towards real estate completely?
Yeah, so actually, I was heavily into engineering. Computer science is something which I did far before my formal education. So even when I was in school, I used to keep dabbling with code. I did my undergraduate and master's both in engineering. But I was always very interested in the application of it. So, more than coding, I was very inquisitive about how to apply this to various systems and solutions to derive a certain output. And finance also I was quite drawn towards. I did a specialization from Wharton parallel to my engineering degree. And the natural course of things, I sort of ended up at Wall Street. So, I got a good exposure to the finance world, and the real estate sort of closely mimics or is associated to the finance world, especially from the investing side. But yeah, that's really how I transitioned from being a core engineer to being a hybrid one. So even today, I still look over a lot of tech. I'm still fascinated by tech, especially in this new AI boom. But so application really is what brought me towards real estate.
So Myre Capital was 2.5-year-old, and I would say it was your baby, right? Because it was your first entrepreneurial venture where you got into Myre Capital. So how did that start? Tell our viewers how that company made you feel that this is the need gap that you noticed in Indian real estate market that could be served by Myre Capital.
No, absolutely. So, initially when we were starting the platform, we did a lot of user surveys. So we tried to, and initially we weren't planning on starting a real estate platform. We wanted to identify an investment avenue. More so, I was looking at investments myself. And, a lot of times when you spoke to people, especially in India, they had a strong resonance with real estate.
Yeah.
It's a tangible asset. Indians inherently love rental income. So we noticed that a lot of people had a strong favoritism towards real estate as an investment avenue, yet they didn't know exactly how to invest in it. They had burnt their hands. They had a bad experience in the past. So we realized it's a very unorganized market. It's a very transactional oriented market. So if you see all your other asset classes, like let's say mutual funds, you have a fund manager who's taking accountability of ensuring that expertise is delivered in that particular segment. So I think that aspect was lacking in real estate. And that's really where we saw an opportunity. So, a lot of people, you'll often hear say that we've created a lot of our wealth through real estate. Property has gone 5x, 3x. Now, I'm not setting that as an expectation, but this is really why people like real estate, right? It's a hedge against the market. It's a tangible asset you can see.
True.
So that's really where we began our journey, trying to understand how we can democratize access, how we can enable a larger segment to participate in the Indian growth story. So, a lot of your institutional funds have increasingly deployed capital in India, right? All the way from Brookfield, Blackstone. Yeah. So the premise was that as an Indian, why are we not participating in our own growth story? So, using that as our vision statement, we began this platform. And one thing led to the other, and we started democratizing real estate. But that was the fundamental premise.
No, that's quite interesting. Also, first of all, how you put it, why Indian companies not getting into this? It's quite well put. I want to know what were the initial challenges that you faced when you opened Myre Capital, because of course it was unorganized. But when it comes to finance investment, now we are seeing an influx of private creditors and AI companies coming in. But I think 3 or 4 years back, people were still skeptical when it comes to certain, apart from mutual funds. Of course, investment is there in terms of stocks and all, but people did not know there can be more opportunities when it comes to finance investment. So what challenges did you initially face?
No, I mean, we faced, I would say, a lot of challenges. I'm not sure if there were some challenges we did face. But to start off with, like you said, there was a lack of awareness.
Yeah.
There was a lack of acceptability of alternative investments. We are a very conservative country. I mean, as much as we like to believe we are aggressive investors, even the penetration in the stock market is probably one of the lowest relative to other equivalent countries. So as a race, we are quite conservative. So, when alternatives like fractional ownership or P2P lending or AIFs, these are things which it takes time to sort of accept and participate in. So I think that was quite a big hurdle that we overcame, via knowledge, via content. So educating more than anything. So I think that was one of the big hurdles. The other one I think is more unique to my case, which is age. So, real estate is fundamentally an industry that was operated by, veterans in the space, that were operated by developers. So it was a slightly more traditional industry. So, when you sort of come in as a 25-year-old and you're saying, I'll buy this property of 70 crores, a lot of different skepticism is there. So I think these are the two aspects which were quite a roadblock, but with time, I think we found our way, we navigated around it.
So under Myre Capital, what were the services that you were providing?
Sure. So when we started Myre Capital, it was a platform to fractionalize or democratize access to real estate.
Yeah.
So what the fundamental value proposition was, like I said, there were a lot of funds participating in these assets. They were yielding good returns. It was risk adjusted because it's a tangible asset with a tenant paying you rental and all long-term, long contract tenants. So yeah, I mean, overall, that was the sort of motivating factor that, this asset class is providing a good return, risk-adjusted return. So that's why we wanted to offer it to the larger investor base.
So tell me your vision or strategy because Myre Capital was your baby, right? And then after 2.5 years, it gets acquired by Aurum Proptech. Were you planning to get acquired after 2.5 years, or there was a strategic move behind this acquisition?
Sure. So, I myself have worked in the VC space. And the reason I say that is, there are two ways always, the two sides of every coin. So whilst VCs come with funding, it comes with certain strings attached. So I was quite averse, at least in our kind of business, to raise venture capital, or for that matter, any capital at all. But we were trying to find a strategic partner who could help us navigate, our way from being largely in an unregulated segment to more of a regulated segment. So, that's where I felt true adoption of an alternative concept like this would come in place. So, this would enable us to scale from what today is a 2,000 crore industry to a 50,000 crore industry. Like if you look at other countries where fractional ownership is happening, single platforms are managing $4 billion, $6 billion. And the point is you can't reach there until you don't have a regulated framework, until you don't have mass scale acceptance. So we needed a strategic partner who, more than capital, aligned on vision, aligned on execution, and gave flexibility and freedom to operate. So, we did a lot of searching. We got quite a few offers, and it wasn't for acquisition. It was actually only for an investment. But we didn't go to the traditional VCs. We wanted someone from the real estate space who understood and also the execution aspect of it. So, in time, the reason we chose Aurum was fundamentally this. Their whole ethos towards their investee companies, their whole approach really aligned with me. I mean, so Ashish is the promoter of Aurum, and he truly believes in giving you full flexibility in achieving your goals. He enables you. So, that's really where I would say stars align. And that's when, we decided to sort of take that leap of faith. It wasn't an easy decision, but today I'm kind of happy that, we did make that decision at that point in time.
And VCs who are very quite much active, especially in PropTech, and gives you a good kind of, network or good kind of, ecosystem, even the ones they have built. So, for example, if Aurum Proptech have invested in Intergrow and then other companies, how does this ecosystem help even Aurum WiseX to grow in terms of expansion, in terms of their network, in terms of their portfolio?
So in a business like this, when you're trying to create an industry. So when we came into the sector, I think fractional ownership wasn't a term known by anybody. Today, fractional ownership, probably every third investor who's an HNI has come across this term. So, when you're creating awareness, when you're creating a brand, when you're creating a concept and investment framework, it requires more than just capital. It requires access. It requires expertise. And that's really what we were looking for. We were looking for a strategic partner who understood the market, who understood how real estate works. So that was basically it. So
we noticed Aurum WiseX has also launched Yield WiseX, right? So how different it is from Aurum WiseX, and what is this platform majorly about?
So about maybe 10 months ago, we realized that our focus was actually investments. Now, real estate comes in many shapes and forms, right? So one is you can go and buy the tangible asset. The other is maybe you can buy a REIT instrument. The third is you can give debt to a developer. So there are various varieties via which and instruments via which you can participate in this asset class. So what we wanted to do is segment the businesses, wherein Yield WiseX will be our portfolio for, let's say, HNIs, where the minimum investment size is 15 to 25 lakhs. We're offering fractional ownership, and we're offering high yield debt instruments, but again at a higher ticket size. We are coming up with a second platform, which is fundamentally going to be for our PMS, which we are launching next month. So that's something we're going to unveil next month. But the idea really was to offer various risk-adjusted frameworks which align with different investor requirements. So some person might say, I'm okay with a 10%, but I want a tangible underlying asset. Someone might say, I'm okay with a little bit of credit risk, but see, I want a 16%. So, giving that variety, that option to investors is really where we started diversifying our platform. So, we wanted to become the one single, platform for all kinds of real estate investments, private equity investments in this segment. And really, that's where our journey has sort of transitioned to since, I think, November. So, November is when we launched our debt vertical. And that was the first proof of concept of supplementing fractional ownership with other investment avenues.
Nice. So fractional ownership, now we have seen a lot of players coming in, and there were a few players last year also. And now every player has a minimized starting, like how you quote 15 to 20. Some have given 25 lakhs. Some are giving 20. But the interesting thing is the IRR they are promising to investors. It can go from your 18 to 22%. So in such market, in such competitive market where fractional ownership is now being highly appreciated, accepted by the investors, and where IRR is being promised by other players also, how you see your company in terms of standing apart from these competitors, and what is your promise to such investors when it comes to IRR?
So I'll answer that question in a different manner. When this starts happening, see, if a 20% IRR was possible and there was no risk, everyone in the world would invest, right? So an arbitrage in a certain segment can't last forever.
Sure.
So usually this happens because of overestimation or because you need to assist your sales team, so you need to give them a high number.
Yeah.
And this is really where the industry sort of starts taking a U-turn, and starts becoming detrimental. So at this point in time, someone like SEBI stepping in is very, very pertinent to put in standards, to put in safeguards, to moderate that projection and set certain criteria and parameters. And SEBI basically did do that. So, in May this year, SEBI came in with a consultation paper, which proposes to add safeguards whilst retaining the value proposition of fractional, but add safeguards nonetheless so that investors are getting the right information. So I think that's a very important step. I think that's a very forward-looking step that will help mature the industry. Usually what happens is in a developing industry like this, if one player or two players sort of become the bad actors, it has a very detrimental impact, not only on them, but the whole industry itself. It breaks trust. And for a new industry, that trust aspect is very, very pertinent. Now, how we plan on setting ourselves apart is always through track record. So we always say that, don't look at AUM, look at track record. AUM is not, and especially in real estate, because real estate is not like equities, where year on year you're going to see something happen. Real estate is slightly more patient asset class, right? It takes a little bit of time for assets to appreciate. So more than looking at how much has been accumulated, people should, at least in real estate, put emphasis on what has happened in the past. I mean, have your returns been on time? What is the returns you've given to someone versus what you projected, right? So if someone's projecting 8.5 and giving 8.5, in my opinion, that's better than someone who's projecting 10 and then giving 7, right? So those kinds of things we constantly kept emphasizing, and even today we advocate for people to emphasize on track record.
That's very interesting because few players obviously boast about the AUM, right? And here you are saying that don't look at the AUM, look at the track record. It's quite interesting and a different take on that. But when it comes to vision and values, because now technology has give a great initiative for these fractional ownership companies also, right? Because there's transparency, investors can easily track, as you mentioned, they can easily even see what's going on with what asset and everything. So how are you utilizing technology when it comes to Aurum WiseX?
Sure. So technology is very close to my heart. From day one, we've had a very lean team. So actually, I'll take a step back. So we were the only fractional ownership platform in the country that was bootstrapped. This became a heavily VC-funded business. But we decided to take the other approach, which was unit economics, which was profitability, but not compromising growth. Now, the way we were able to achieve this was through technology. We automated our operations. Even to date, our entire operations is managed by one person, because that person is supported through technology. Now, that person's job is not to do operations; it's to find use cases that we haven't addressed and then work with the tech team to implement technology that sort of addresses that aspect. So, all parts of our company have been built like this, which are tech supported, tech led, innovation led, and that's enabled us to maintain a lean team. So today, of the alternative space, we have the smallest team by number of people, whilst I advocate against AUM, one of the larger AUMs in the segment. So, that's how we've used technology in the past. Something cool that we are doing now is, whilst there is an AI hype, but we are using it for a lot of internal purposes. Like, for instance, sales team, not only in our business, in any business for that matter, have a perpetual problem, right? Yeah, I'm getting 500 leads. Who should I call? Who should I not call? So every business has certain leading metrics. Like for us, NRI is a good lead. Someone who maybe is working as a high salaried professional is a good lead. So how do you extract that data? How do you collect that data? How do you utilize it? So, that's what we're using AI for. We've started doing ranking of leads. We'll be launching, our AI platform shortly. We're actually coming up with a name for it. But that's fundamentally to support our sales team, to give them that intelligence as to who to call now, who not to call. And the second side is obviously towards asset selection. So we get a lot of opportunities. A lot of them can't be evaluated in real time by, our team. We don't want to build a acquisition team of 30 people. That's not the idea. We want to use technology to shortlist out of 100 opportunities, the 10 that should be evaluated, and then manually evaluate those 10. So this is how we're using tech, not to replace functions, not to disrupt or remove people from the equation. We're using it to enable people to run things more optimally.
So a lot of people generate leads through Facebook, through Google. How do you utilize such leads? because a lot of developers, a lot of everyone in real estate are utilizing this to get leads, but there are problems when it comes to getting the serious buyers, right? There are problems when it comes to leads being double or being not accurate. So are you also facing such problems, or you're going to build this filter in the particular AI which you're planning to launch?
So actually, this is something we had addressed from the very start. So I'm still very heavily into marketing. And the way we address this is actually not with AI, but with machine learning. So what we do is we collect more than 500 touch points on any user in real time. So all the way from the time you fill the first form, like you probably put your email, phone. Now, usually people IP address is also exposed. So I know what city they're in. I know which country they're in.
Yeah.
Through the phone number ka country code, I know if you're NRI or domestic. Now, when you come to my website, have you spent 2 minutes on the homepage? Did you spend 10 seconds on the homepage? How many times have you logged in? How many emails have you opened? So all these micro data is what we collect. And what I truly believe is that, when you're asking a user to fill in information, that information can be inaccurate, but usually behavior is the best indicator of intent. Right now, if you're spending time on my emails, you can say you're interested or not, but I know you're interested. True. So we kept collecting this micro data, and we kept pushing this micro data as signals to both Facebook, Google, the various ad platforms that we use, and whitelisting and blacklisting certain funnels. So we set up an automated process by which this keeps happening, and we keep refining. So the more users that come, the better our data sets become, and the better the lead gen becomes. So today we're sitting at a very, very attractive qualified rate. And again, the parameter for me always for marketing has not been number of leads. It's not been cost per lead. It's always been qualified ratio of the number of leads coming in and the cost per qualified lead. Right? So that's what we've been optimizing for.
So how do you define the qualified lead? Because there be so many leads coming in, right? As you mentioned, there are customers who might fill the wrong information. There are customers who might, I don't know, like when I get certain kind of ads, and I've tested this, I would put, even if I put xyz@gmail.com, it can get submitted.
Right.
So how do you come out with the qualified leads?
Sure. So what happens is that the qualified gets, so that status gets allocated to an individual lead over time. So we do various kinds of testing with the user, like we send them a bunch of emails. Now, if none of those emails have been used, then, of course, he's not qualified. We do certain OTP processes. So, again, if the OTP is not validated, not qualified. So we have a certain set of criteria. Only once met does the lead get categorized as qualified. Now, that also involves a certain level of interest. So, we've quantifiably made a framework which defines interest, which means that you should have opened X number of emails. You should have spent maybe 15 minutes on a deck that I've sent you. So we collect all this micro data via which we categorize intent.
That's quite interesting, because all these while we have seen leads getting generated for developers. We see their ads, we've seen Insta stories and everything to submit forms. But it's very interesting to see that fractional ownership where the companies are also, because I'm talking to other companies and they're saying they're heavily using Facebook, Google Ads, other platforms to generate leads. So when we talk about such leads, are you saying investors are actually coming through such platforms for the fractional ownership?
Absolutely. So today we do about 50-60% of our sales purely B2C, which means through ad platforms, through PR, through organic, and 40% roughly is through our partner network. So contrary to my expectation as well, people do come from Facebook ads. They do invest 1 crore plus, 50 lakhs plus, and the kind of profiles that you get, unimaginable.
Nice. So there's an interesting term which I have noticed in Aurum WiseX platform. Also, you have used the word new reality. Could you tell our viewers what is new reality, and how do you define this? Like,
sure. So a lot of people, when we started off our platform, they had various engagements with real estate investing, albeit via brokers, or maybe buying an apartment from a developer. But these are all traditional methods of investing, and we were doing something different. So to reinforce that vision, we started this word called neo realty, saying that this is a new age way of investing, new approach of investing. The things that we are offering are not traditional. We are doing it through a differentiated perspective, and that was really the whole intent behind neo realty.
Nice. So coming to the recent announcement that was done by Finance Minister Nirmala Sitharaman, she had announced that all the direct listing, equity direct shares will be listed in the IFSC. where it gained a good development from the Indian companies also. Now Indian companies have an option to direct list in foreign exchange through GIFT IFSC. What's your take when it comes to such announcement? How does it impact the overall commercial real estate?
Sure. So, when a country opens itself up to foreign capital, and I think India has done so gradually, but very conservatively, you would have only seen foreign money through funds like Brookfield, Blackstone also pour in the more recent times, right? Maybe 10 years ago, these names were not as prominent as they are today.
Yeah.
So, India has taken a lot more of a conservative outlook in terms of enabling foreign capital, enabling companies to go abroad, which has allowed us to be quite stable, right? So today we're not very dependent on, like, right now US is debatably going through a recession, but that's not having the same impact on us as it is on other countries. True. So foreign money is good. Access to foreign money is good. It enables the whole country and ecosystem to grow. Real estate is the core underlying asset, right? So let's assume IT sector grows. IT sector, the number one thing is IT parks. IT parks are real estate. Yeah. So at the back end of growth, you'll always find real estate. So, participating in real estate is like participating in the Indian growth story on a more fundamental level. So I do feel that, the headwinds of India, the favorable demographics, the sort of perspective taken by SEBI, the forward-looking policies that are coming in, all of these things are going to take India to a very, very different level, which in turn will take real estate to, very progressive level.
True. And as you mentioned earlier about HNIs, do you feel the current, the global politics of the economy, which affects right now is affecting the US, China, even UK, does it affect your investors' portfolio too? People who are investing from outside, when such, news is happening, does it affect your portfolio of investors when it comes to fractional ownership?
Sure. So actually, this is the beauty of alternative investments. So equities are more susceptible to market volatility. Yeah. When a global event happens, the markets go up or down. Real estate doesn't move like that, at least not A-grade real estate. So even when COVID happened, right, your B-grade, C-grade buildings got vacated. Your A-grade buildings didn't get vacated. I mean, in fact, the price went higher because people understood and appreciated the importance of quality, the importance of, the workplace environment. So usually these alternative investment products are not closely correlated to market. So even though you go through volatility, people use these kinds of products as hedges against these kinds of downturns. So even in the pandemic, you would have seen a huge upswing in people investing in gold, in real estate, because these are the hedges against market volatility.
True. So also tell me, when it comes to the current market in Indian real estate finance investment, what we have noticed, there influx of AIF companies coming, fractional ownership is there. We are also noticing like recent company like HBITS got regularized by SEBI, getting AIF category 2 fund to raise for commercial properties, where we haven't seen any players getting into it apart from Resi AIF players. Where do you see Aurum WiseX heading into this particular space?
Sure. So, as a larger vision, as a longer term goal, we want to be able to offer investors various kinds of frameworks via which they can participate in real estate. So, we started off with fractional, which is still one of our core offerings. We supplemented that with debt, which is again one of our now established verticals. Next month, we are launching a PMS. We have an AIF license, but we are probably going to launch that, early next year. So the idea really is that, one size doesn't fit all. Each has their own preferences towards risk and returns, towards the liquidity, towards, the amount of time horizon they want to invest for. So we are making all these different kinds of frameworks accessible, and we are doing it all from a very curated perspective. So on our platform, you'll never find a third-party product. Everything that we offer, we originate ourselves, so we can control the risk associated to each offering.
So we would be seeing you guys getting into AIF as well?
Absolutely. So we are very keen. We are in fact, so once the PMS that we launch stabilizes over the next 4 to 5 months, post that we'll launch, our AIF.
So is it like a strategic, call that under one umbrella, you want to provide different kind of investments to your investors, the different portfolios? Is this like a strategic vision that you guys see for the company?
I'll put it another way. We've developed very good expertise in real estate and credit and basically we want to scale that up into all these variety of products, right? So there's the AIF real estate industry, there's a PMS industry. Now we want to enter that from a real estate perspective. So yes, in terms of having all of this, we definitely do want to have all of this. And I think because of the kind of expertise that we've built, it will be easy for us to supplement each vertical with the next.
And would you be focusing only on commercial, or you be also heading into residential properties?
So right now only commercial. We have a strong core competency in commercial, and we want to stick to that. So we'll start with commercial. We're a little bit of a conservative platform, and we'll see where we go from there.
So as we've seen so many reports recently coming in and showing, and it has compared with the residential, office commercial space give you good rental yields, right? So what is your take with the 2023 and the next year? What current trends when we can see in commercial real estate, and what other evolution of finance investment we can see in real estate?
Sure, absolutely. So, India is the ITS hub globally.
Yeah.
So a lot of the outsourcing comes to India, albeit from your consulting companies, your large tech companies. A lot of their main outsourcing facilities are set up in India. Now, why does this happen? So there are three fundamental reasons. One, you have $1 per square foot ballpark rentals in a lot of these IT parks, which is very favorable when you compare it to, let's say, rentals which are maybe 4-5x in the US. The second thing is we have a lot of talent and very affordable talent. So, when you look at the difference in wages in absolute terms between us and these countries that are outsourcing to us, it's drastic. So, it makes it very, very economical. The third reason is we have very favorable demographics. Right now, 50% of our population is below the age of 25.
Yeah.
So when all of these workforce are entering when all these individuals are entering the workforce, it allows for a ecosystem of IT or industry like IT to thrive. So, that's one of the main macroeconomic factors that has driven real estate or commercial real estate even in the past few years. Like if you see what is office space in commercial real estate fundamentally, the maximum stock is in IT parks.
Yeah.
The lowest vacancy is in IT parks, and that's because of these reasons. So that's one of the major things. The second major thing is that India is coming out to be one of the most favorite economies globally, and that's because of the China aspect. Them not having such good global reputation anymore. It's companies are backing out of China today. A lot of European countries have weaker economies, or sort of spiraling economies. UK is going through a crisis. US is going through a recession. So fundamentally, India has a very, very strong, headwind. Our growth is continuing. Our companies, not only in real estate but overall as a country, are showing sustained growth. So, in a macroeconomic condition such as this, I feel India is poised for, very, very good growth trajectory. I mean, often I say, these are the next 10 years for India. This is where we're going to see maximum growth, maximum development happen in the country.
True. So let's talk about the challenges of this market, because, of course, the SEBI has got on good regulations to make sure no discrepancies happen, be in any finance investment companies, be AIF or be fractional ownership. But when it comes to entry barrier, right? AIF minimize starting is 1 crore. And fractional companies as yours, every company start with all the portfolios from 15 to 20 lakhs. My question to you is, when it comes to so many companies getting involved in this particular space, there can be problems, and of course, as a hypothetical situation, there can be problems where the company can even take the portfolio and give out, right? And it can affect the market sentiment, it can affect the investor sentiment. So what do you think the barrier of the entry or the entry threshold should be increased by the government, or there can be more scrutiny by the government? What is your take?
Sure. So, this question I can answer a lot better today, having dealt with regulations a little bit more in the last few months, especially in the fractional space. What I've seen at least, so I'll first talk about the fractional regulation, because what I've seen from SEBI's approach is that they're not trying to ban an innovative framework. They're not trying to be, very, very conservative. They're actually trying to promote frameworks which have a strong value proposition for investors, while ensuring that the retail investor, he's getting all the information. He's not being basically led down a let's say, a scheme or a bad investment or things like that.
True.
Now, how do you avoid bad actors in the industry? I mean, like you're saying, there might be a platform that comes up who doesn't follow all the instructions. So that's really where SEBI comes in. Like, at least in the fractional ownership regulations, they're requiring us to have a certain amount of capital on our balance sheet. Now, why are they doing this? Because they assume that someone who can arrange this amount of capital and keep it liquid on their balance sheet is serious enough, right? They have enough skin in the game.
Yeah.
They're forcing us to invest 15% into every property. Now, again, why are they doing this? They're doing this to ensure that we have enough skin in the game, that, what we are recommending to someone, we are also confident enough that we're investing into. So a lot of SEBI's regulation is aligned to ensure that what we are doing is in the best of intent for the investor. Now, investments can go either way, but the idea really is that we shouldn't be mis-selling. No platform should be mis-selling. There shouldn't be bad actors, and that's really what compliance really helps ensure. So once you get compliance in, once you get regulation in, it allows the industry to mature. I mean, just giving a parallel to this, see where the mutual fund industry was 15 years ago.
Yeah.
Right? There were a ton of bad actors. A lot of things went south.
Yeah.
SEBI over time iterated. They made the framework more sophisticated. Today, look at mutual funds. I mean, I think everyone has some level of exposure, right?
True.
So a lot of confidence builds in the asset class. It becomes mainstream. So whilst when SEBI comes up with regulation, the best way to describe it is short-term pain for long-term gain. So it is short-term pain for platforms like us. We have to adapt. There are a lot of criteria we have to fulfill. But in the longer term, I mean, the kind of gain that you realize by ensuring all these things are in place is really unprecedented.
So too much information, as you said, is always there, but can be also a harm. For example, like how you quoted, like maximum population in our India is below 25 years, right? There are a lot of fintech influencers. There are a lot of influencers around who are telling you what to invest, where to invest. And when it comes to the debate of, REIT versus fractional ownership, they are mixed. Where I even go through YouTube and other influencer recommendations to the youngsters, some are suggesting REIT is a good option because it gives you immediate returns, like how you invest in a stock. But when it comes to fractional ownership, and of course, person who is below 25 won't have right away 15-20 lakhs to invest. For him or her, the option REIT sounds quite interesting. So what's your take when it comes to such debate, REIT versus fractional ownership?
So, what I truly believe is that not only in this debate, but any narrative associated to guiding someone's investment choice has to be regulated or has to come under certain frameworks of checks and balances, right? So we are seeing this, like you correctly said, in the influencer space. There's a lot of scrutiny of that segment fundamentally because of them. And I'm not going to say all of them. Obviously, there are good ones and bad ones. But one of the major taints of the industry is that they're selling what is in their best interest, right? So the ones with higher margin products or the companies in which some of them have stake, now promoting that is not doing it in the best of intent. So usually now SEBI is even stepping in here.
Yeah.
Right now they're putting in certain checks and balances on these kinds of influencers. So you can't sort of pick up one part of the whole process and try to regulate it until end to end. You don't have a system, you don't have certain guidelines. It's difficult. It's difficult for it to become mainstream. So whilst influencers are important, they raise awareness. Whilst a lot of these content channels are pertinent to raising awareness and building a category, it has to be done in a controlled way.
So what's your take when our viewers want to be informed and educated when there's a comparison between REIT and fractional ownership?
Sure. So, the fundamental difference would be like picking a stock versus investing in a mutual fund.
Yeah.
Now, what happens in a mutual fund? Whilst in mutual funds, you do know the underlying property equities, but you don't necessarily pick them yourself, right? You're just investing into a pool, into general sentiment of the equity market. Now, similar with REITs, like you're investing into the general sentiment of the real estate market. Mutual funds will have a lower return against a stock which is going up well. Now, why do you pick these superstar, stock pickers? Like, I mean, lack of a better example, Rakesh Jhunjhunwala. The reason is he's able to identify those stocks, the ones which give you multi-bagger returns, as opposed to mutual funds which will give you sustained growth, but they'll give you a lower growth. So similarly, in a REIT, you will get growth, but in fractional ownership, you're picking that one asset. You're picking an asset in which you're getting opportunistic entry at a lucrative price. So experts or platforms like us identify those opportunities and enable investors to participate. So that's the fundamental difference. Both are means of accessing real estate. One is a more concentrated, opportunistic, return-oriented product. The other is more of a long-term, like a REIT is more of a long-term investment, slightly lower returns, depending on how the other does. But this is the fundamental difference.
And what are like the exit formalities? Because in REIT, if I put in the stock, I can immediately even take that money out also from the market. When it comes to fractional ownership, even for our viewers to understand, if they're investing, is it like a 1 year lock-in, or do they have to wait to see how the market is going and then exit, or can they do the early exit and it might affect their returns?
Sure. So, I'll talk about our platform because I'm not certain about the others, but we offer a very active secondary market which enables investors to any point in time exit their fractional shareholding. So the full property gets exited down the line at an optimal exit value, but in the interim, let's say if someone has a pressing need of funds, they can reach out to our team and we list it on our secondary market. Now, just purely based on data, we've had about 27 exits in the last 2 quarters. The average time to identify liquidity and find a replacement buyer has been under a week. So, whilst this is not an indication of future liquidity, but in the past it's been quite liquid, and the reason to that is actually good asset selection. None of our properties are vacant; all of them are yielding. Rentals are intact, so there's a lot of confidence in these properties. Now, of course, if a property gets vacated, there's no rental income for some time, the property has been bought at a high price, then yes, secondary exits will be a challenge. But in terms of liquidity, we are trying to achieve the liquidity of a listed REIT, and under SEBI's new regulation, we probably will be able to. So that's also another form of a REIT. But in the old avatar, I would make a closer parallel to, let's say, owning your own commercial real estate asset.
Yeah.
Right? It's like owning your own office versus this. So this has a much more favorable liquidity structure. But in terms of the overall nuances, it's more akin to owning your own asset.
So what kind of properties do you have the portfolio of? Like grade A properties even have office, warehouse, data centers. What kind of properties are you guys holding in your portfolio?
So currently primarily office space, and the reason to that is because leasing is very long term. So MNCs sign 10-year, 15-year contracts. We try to pick up only new assets, so assets that are constructed maybe within the last 3 years. The reason to that is, as a building ages, the ability to realize appreciation starts to become lesser and lesser. Now, of course, there are outliers like a mega max city.
Yeah.
But in general scheme of things, the newer building will show higher appreciation as a very broad rule. So we fundamentally stuck to office space, again in very, very core micro markets, A grade. So we have like in Mumbai, next to the airport. In Bangalore, we have an ORR. In Pune, we had in Hadapsar. So these are very, very mature micro markets in which leasing is not a challenge, in which there's demonstrated track record of tenancy, of leasability, of established market rentals. And even through the pandemic, not a single one of our tenants asked for a discount. None of them vacated. In fact, if they vacate today, I'll probably be able to achieve a higher rental. And this happens by good asset selection.
True. And what are the current cities where you guys are active in?
So we wanted to focus on tier 1 because in volatile times like COVID, the more mature the market is, the less volatility you're going to see. Like in ORR in Bangalore, there was almost no tenant that vacated, and even if they did, almost instant replacements did happen. Whereas if I take a market like, let's say, Jaipur, there were vacancies there and they're continuing. So that's why we wanted to be very conservative. We picked up only in key A grade mature micro markets. And going forward, I think we're going to continue to stick to that strategy because another important thing to understand is your target segment, right? So someone investing 25 lakh rupees, he wants his yield, he wants some appreciation. He's not looking for a 20-30%, but he wants stable income, right? So we don't like taking unnecessary risk. When sort of making these kinds of investments. Like if a HNI is putting in 30 crore, he's aware, he's knowledgeable of the risk he's taking, then yes, he can go and take a project in a T3 city, and he might realize a 4x return in a short period, but he also might realize a downturn.
True.
So you have to match the kind of risk that you're onboarding with the investor mindset that you're catering to.
And do you guys also have a certain criteria when you're selecting investors for your portfolio, or is it open like whoever comes in and first come first basis, or is there a particular filtration from your end also to, of course, there are few investors who might put like, we are ready to put 25-30 lakhs. But do you guys also take the call key let's not give this portfolio to him. Do you have a certain checklist for the investors?
So we don't discriminate based on any basis other than, for lack of a better word, a criminal track record. So we have a platform which is called Karza. So they're a third-party platform. We run our KYC and identification checks via them. It's an instant API-driven solution. Really cool, honestly, if you ask me. And they give us insights. So far, only one potential investor, we couldn't accept investments from. But other than that, no such.
Because of the criminal background.
Yes.
Okay. So let's talk about PropTech landscape. So you are quite active in this particular field starting from Myre Capital, and you would have noticed how the PropTech landscape is, evolving in India also. So what's your take when it comes to the PropTech ecosystem? Are we maturing? Are we getting the right technologies, or is there still a need gap that can be, taken care by the PropTech companies in India?
So I think extending this from PropTech to general startups, I think India is running on a 5-year delay to the US. So companies that are IPOing today in the US, or startups that are IPOing today in the US, are sort of getting Series A funded in India, right? So you have a fractional ownership platform that's IPOing in the US. Fractional ownership is at a Series A level in India. You have a Open Door, which is a instant purchase platform in the US, which is IPO'd. In India, you are seeing platforms hit Series A now. So I think that there's a 5-year time lag in most. Zomato is another example. In the US, there's a listed one. So there is a time lag. So I think that there are footsteps that we can follow. There's inspiration that we can take, which makes our lives as a founder a little bit easier. But like I said earlier, I think the next 10 years are India's 10 years. This is really going to be the growth story, not only in India, but India positioning itself globally. So similarly, PropTech is at an upswing. I mean, we are seeing unprecedented adoption of technology. Pandemic accelerated it. AI has further accelerated it. You're seeing solutions with developers adopting, and developers usually are a little bit more resistant than other industries at adopting such technologies. But Apna Complex is an example. You have HouseMonk, which is sort of giving SaaS solutions to residential buildings as well as offices. Nestaway, I think that's a name which everybody knows today. They've really changed the way. I mean, in Bangalore, I don't know very many people who would have come from outside who haven't used Nestaway, right? So we're seeing a really big transition towards these kinds of solutions. So I do think that in the next 5 years, PropTech is really going to be at its peak. And just to give context, when we started 3 years ago, I mean, I didn't even know a lot of these businesses, right? A lot of us are still building, like fractional ownership didn't exist. Co-working, managed leasing, all of these things are very, very nascent. And look at where we've already reached.
True.
You have No Broker, which has hit Unicorn Plus status. You have Nestaway, which is a whole different league. Housing.com. A lot of these platforms are making a name for themselves now.
True. So it's a good transition which we are seeing in PropTech landscape. I agree with that. But when it comes to investors, what is your take when it is investors who are investing in PropTech? Are we seeing that openness? Are we seeing more maturity in that front when it comes to investing in PropTech companies in India?
So I truly believe that investing, it goes through cycles. Right now we are in a cycle where people are being realistic, where they're looking at financials, they're looking at EBITDA, profitability, with revenues. They're not ignoring revenue, but they're also looking at these other metrics. Rewind 1.5 years. Conversations about profit were not happening. Conversations about EBITDA were not happening. It was all about, okay, if you've achieved X growth, I'll give you an X multiple. And that's a very dangerous ecosystem, right? Because time and again, we've seen this, that when you raise money at an unprecedented valuation and you can't support it, it leads to only one out of two things. Either the company faces a downfall or the VC faces a downfall. Only two things happen. So I really think that pricing of startups has to be aligned for a longer term. It will not only give investors a better return, but it'll give startup stability. Sometimes a good idea is taken, too much money is pumped into it, and it bursts sooner than you can actually, it can even evolve. So overall, I think investors are getting a sense of that, especially in the last couple of, you saw the info edge write-off of Broker Network, correct? So these are the ones which are taken at really aggressive valuations. So yeah, I think it goes hand in hand. Investors giving realistic valuations, realistic pricing, and then startups living up to it. So I think both these aspects will help the industry mature a little bit more.
So you yourself an active angel investor, right? So when it comes to investment, as we are discussing, what is your particular criteria or checklist to invest in certain companies?
Sure. So I wouldn't say I'm active. I do it one off, but my idea usually isn't. I like only betting on founders. I think that a lot of the business is dependent on the conviction of the founding team and the founder. And I usually like to give that check before the website is also built. So really, really early stage, so that I can act as a mentor. I've seen what the last 3 years are like. And I appreciate the value a mentor could add, and I have added to my journey. So and continue to add. I mean, a lot of the more experienced founders, I constantly run ideas through. I use them as a bouncing board. So just passing on the same, doing my bit. So that's really the perspective. So I'm very sector agnostic. I'm idea agnostic. As long as the initial team has a lot of conviction, then I sort of give them a minor investment and act as a sounding board for them.
But betting in founder, don't you think is a risky situation? Because as you quoted about InfoEdge, they bet on the founder, right? Because the founder was known for the former housing founder, and then because based on that particular knowledge or based on the particular experience, they bet on the founder. Don't you feel that's a risky proposition?
So see, I'll tell you, companies come in two stages. One is when it's become a business, and the first is when it's an idea.
Yeah.
So when you're when you're investing into an idea, in my head, I write it off. Right? It could go either way. You can't. This is not a financial investment. This is more of paying it back. People helped me when I started. This is helping others when they are starting. It's more of that kind of situation. When coming to businesses that people are taking heavy stakes in, like broker network, I think corporate governance is not given enough importance. Today you're hearing a lot more corporate governance. I mean, one third party giving credit to Aurum Proptech that corporate governance is on point, best practices in place. And I think these kinds of things really help keep everybody in check. The founder, the team, the investor. There's a certain framework in which you're operating. So I think these things are really important for the long-term survival of startups and investors.
True. And you yourself quoted you're quite tech heavy, right? You get involved in technology and everything. Is there any specific tech that you're looking into invest in so that our aspiring entrepreneurs who are watching could know about it?
So more than tech, I invest in one simple philosophy. Ideas are cheap, but execution matters.
True.
So I believe any idea can be a fantastic idea if the founder and founding team have enough conviction, right? You've seen small ideas. I mean, Milkman, they deliver milk to people.
Yeah.
Look at where they are today. They've just been acquired by Reliance. So ideas come in many shapes and forms. So I wouldn't say that I'm, looking actively at a certain tech. But that being said, I'm very interested in tech. So I constantly look at ways of integrating it. Like AI also, I myself have actively been playing around with the APIs. This is what I do on Sundays. So this is one of my hobbies. I play around with new tech. I integrate it here. I try to see what more can be done with it. But yeah, that's fundamentally the approach.
So in the dynamic PropTech landscape, we are noticing Acqui hiring is being quite prominent. Few companies are going in that model. So from your vantage point, how do you feel about this particular Acqui hiring for the overall individual or the team that is being hired in that process?
Sure. So I think that for Acqui hire to work out, there's one fundamental principle that the people being Acqui hired have to have skin in the game.
Yeah.
So why does the Acqui hire happen? It happens because the team is good, but they're not being able to scale for whatever reason that might be applicable to them. Now the company that is Acqui hiring, they usually have a certain level of scale. So embedding this solution, they can sort of fast track the growth of that idea. So, this is the basic idea behind Acqui hire. So I think it's a good way for a company to sort of let their solution scale up via the help of another platform. But usually if there's not enough skin in the game or enough participation and upside of the individuals being Acqui hired, then that's where things fall apart. Because, one set of people are coming from a mentality of owning equity, of being in the startup space, the founder mentality, ownership. Now, when you take all of that and remove it, then and you give them a little bit of money that may seem to the people being acqui-hired today that it's a good idea, but in the longer term, it's not a good idea because they're built in a certain way, which is why they took that path in life, right? So that's the fundamental aspect, and I think some companies are doing it well, where they're acqui-hiring, they're giving skin in the game, they're giving participation of ESOP to the larger pool. So that's an interesting proposition. But then there are others who are more traditional companies who are saying we have no concept of ESOP, you just take X amount of money and come. Those are the ones which are going to face, in my opinion, challenges.
So do you feel the bigger companies who are hiring, doing this acqui-hiring, where they are not giving the money, but of course getting their particular team or the tech intact, and in return they are providing them the stakes in their bigger companies, is it a good move?
So, it depends again on a case-by-case basis. Now, for a founder, these decisions are quite difficult. Let's assume that the business is not working, right? So he has 2 or 3 different moves he can make. He can either shut down the business and restart as something else. He can either continue and reduce his team, fire 50%, which you're seeing nowadays quite often, some founders making that decision. And the third, obviously, is to let the company or the idea survive, of course, in a different avatar as part of another company. So all three, there's no right or wrong answer, but I think it's a very difficult decision for any founder to make. And the result also depends heavily on his adaptability, on the acquiring company or the person who's doing the acqui-hire, his acceptance. So, there's a lot of variables.
True. So lastly, I want to know from you, because you've been quite active in this and you had started your entrepreneurial journey with Myre Capital. For the aspiring entrepreneurs who are getting involved now in the real estate market, especially in India, what advice would you tell them?
So initially things don't seem like they're going to work, but go in every day. If you have enough conviction in your idea, someday it's going to start working. And just to draw a parallel, when we launched our platform, for the first 7 months, we couldn't raise a single rupee. And in the next 3 months, we raised our first 80 crores. So, things start to work out, but the main point is you have to go in every day, be positive, work towards an idea, adapt, change, learn. And I think that's really the biggest skill set. Usually people get disheartened. They feel like this won't work, that won't work. And there's enough negativity which happens in a founder's life. So, supplementing that with your own is not ideal. So, you have to be quite optimistic for things to work out. And like I said earlier, execution matters. Nothing beats execution. You can have all the VC money in the world. You can have as many people as you want. But if you're not going to execute, none of that will do you any good.
True.
So execution, time and again, trumps any other aspect, being in the startup space.
And what advice would you give to those entrepreneurs who are contemplating, do they raise during the idea level, or do they just bootstrap and start for a year, 2 years to see how the profit is going and then go for the funding? Because there have been a lot of, questions like this come in when people read, okay, certain company has raised just on idea level such huge amount, and then people think, okay, should I just focus? Because focusing on raising money takes a huge, I'm sure you also know, huge chunk of time from the founder. So what should a person do entrepreneur level when they are starting their journey in this PropTech?
Sure. So I think, before deciding if to raise money or not, a lot of founders, at least the ones who are starting, need to understand that raising money is actually like an agreement with someone. You're telling that person, hey, give me this much money today. I will grow this idea and this is what you'll probably get back tomorrow. Now, a lot of times founders don't understand this well enough, as simple as it is. They feel like, hey, I'm getting X amount of money at this value, but they're not looking at the flip side that I have to give this back at some point. So what happens is that founders raise money at a ridiculous valuation. That valuation doesn't hold. Now, tomorrow, if the valuation drops, the only one losing out is eventually the founder, right? He can't, and none of this money goes to the founder to begin with anyway. This all goes into a company. So I always say raise as much as you need. Raise for the next 12 months. Don't try to raise for 10 years. If you think you need 10 crores for a year, there's no point raising 100 crores. Right? Having 90 crores in your balance sheet, if you're not using it, but you have to give a return on it, it's a very bad financial decision. So, only take as much as you need so that you can give a return on that which is commensurate. So I think, founders also have to sort of align themselves to understand what is the capital requirement of their business. And accordingly raise capital. So I wouldn't say that, raise capital or not raise capital. run as far as you can without the external investor. Equity is very precious. When you need money, don't shy away from diluting, but then dilute for a purpose. Dilute so that you can go from X to 5X and have that path charted out.
So we'll come to the last segment, that is rapid fire, quite famous for our series. So before I start asking the questions, you need to be quite quick. Whatever first thought comes in your mind, you need to say that. Yeah?
Sure.
So let's begin. So one word that describes your leadership style.
Delegation.
Biggest source of inspiration.
Cadre.
And favorite productivity hack.
Technology.
Okay. Preferred communication style, text, call, or email.
Text.
The last new skill you learned.
AI.
Okay. Best advice you have ever received and the worst advice.
Don't raise more money than you need.
And the worst advice?
The worst advice, scale up your sales team.
Favorite quote that keeps you motivated?
Well, my team, they keep me on my toes.
What do you do to unwind after a long day?
Usually I go to the gym.
One skill every entrepreneur should have?
Conviction and smart work, so not hours, but making every minute count.
And if you had to describe yourself in 3 words?
That's a tough one. I'd say collaborative approach, open-minded.
Twitter or LinkedIn?
LinkedIn.
Your go-to strategy for overcoming challenges?
Conversations.
Nice. A mentor who shaped your journey?
My parents.
One entrepreneur or a person whom you inspire and admire, and why?
So there are actually quite a few, but I'll start by saying Jitu, who is actually the founder of Hello World, Anuj Puri, and of course, Ashish as well. So the Aurum Proptech founders and entrepreneurs in their own right, some conventional, some traditional, but a lot of learning from all of them. Very different approaches to problem solving, but a lot of learning from a lot of them.
Any one book that has quite resonated with you for the career-wise or personal-wise?
The last book I read was Ashneer Grover's Doglapan. I would say maybe not inspiration, but entertaining.
One thing you wish you knew before starting your entrepreneurial journey?
How hard it was going to be.
Okay. Biggest lesson from a business failure?
To adapt, to change, to not be very emotionally attached to ideas.
That's a good. Biggest challenge in PropTech industry right now?
Adoption. So I think whilst it's being addressed, there's still a long way to go.
If you could have a superpower for a day, what would it be?
Replicating myself.
And do what with that power?
There's so many things to do.
So basically
so many
multitask all the jobs.
Yes. So there's so many ideas, so many things to do. I think time is less, work is a lot.
Typical entrepreneur dialogue that is. Okay, the one thing you can't live without besides your phone?
That's a tough one, but my notebook. Actually, I can live without my phone quite easily, but my notebook is like my thought process.
One thing people do not know about you?
One thing people don't know about me. People, I think, know everything about me, but so I'm a very avid chess player. So nice. I play every day for 2 hours.
Nice. And what's your hidden talent that not many people know about apart from being the chess player?
I'm heavily into sports and athletics. So I used to do track running, basketball for the state. I played squash for the country.
Nice. And if you had to invest, you have 3 options. I'm not putting fractional ownership in this. Cryptocurrency, mutual funds, REITs, and buying an apartment.
So I'd go mutual funds, REITs, cryptocurrency, buying an apartment.
Nice. So thank you so much for joining us today. It was lovely having you here today and talking about fractional ownership and also about the future plans you have with Aurum WiseX and Aurum WiseX.
No, absolutely. Thank you for inviting me. Great platform. Really love the discussion. Thanks.
Thank you.